And we're officially live, broadcasting only on onedealaway.com/live. My name is Nev, this is Money Matters, and today we have an incredible episode because it is Thursday, right? It's Thursday? Hold on, let me check. It is Thursday, October 8th, and Thursdays we do talk real estate. Well, because it's Thursday, because it's fun, because I enjoy it, and hopefully you do too. So, today's news, we have huge news, huge news. We're going to be talking about mortgage rates, the fact that they're actually dropping yet again, and what that actually means. We're going to, of course, look at the rates. We're going to look at the areas or the towns that have lost the most people and gained the most people, which is great if you are a investor or an investor, I guess, or a potential investor who is thinking about maybe I should invest and where should I go. So here are the areas that we're going to be discovering together of where it makes sense potentially for you to invest in. We're also going to be talking about some major changes that are coming to New York City that you absolutely want to know about, especially if you A, live there, B, are developer potentially, C, maybe an investor looking to jump into New York City and attempt to ride the next boom, or bust. I don't know which way it's going to go. Nobody does. And we're going to be looking at some additional conversations and pieces as far as learning a little bit about commercial real estate and how that works, and are the deals that we're seeing right now in the apartments good deals or bad deals. So we're going to be learning a lot of stuff, discovering a lot of stuff, and I am very, very excited and blessed to be here with you. I do want to welcome everybody watching this live on onedealaway.com/live. If you're there, sign in, say hello, and save your cues for the A's later, because we're going to hang out at the end of the show as always. For everybody else watching this elsewhere, I don't know, YouTube, Facebook, wherever else this video might end, do me a huge favor, smash the like button right now. Do subscribe to the channel. If you're on YouTube, obviously hit the bell notification because you want to hear about these things as they come in, and you want to stay tuned into what's happening, right? And of course, do forward this stuff. And if you want to leave some comments, questions, concerns, hey, let me know. Put it out there. I do read them. I do respond. So I look forward to hearing from you. All right, y'all. Let's do this. Good morning. Did you enjoy that? I personally have. Yes. So hopefully you are enjoying your morning. I hope you have some coffee, tea, or whatever favorite beverage of choice might be for you, because we're going to hang out. I'm going to put my keyboard away because I'm not going to be keyboarding. I'm not going to be keying. I'm not going to be doing any of that stuff. What we're going to do is we're going to hang out and learn. And of course, one of the first news that doesn't always sound like it's real estate connected, but it does have connections to it. And it does have a connection in the retail and in commercial real estate space. And this is the story about Ruby Tuesday. If you don't know Ruby Tuesday, let me show you what's going on. Let's share the screen, y'all. Let's share the screen. Ruby Tuesday is basically filing for bankruptcy. And, there's a video, and I was trying to figure out how the heck do I get the sound to you. And I haven't figured it out. I gave up because I was like, well, I don't want to run late just for that piece. If I run late, give me a better excuse, right? So, but basically what is happening is they're going to be closing about 100 and some stores. Hold on, let me see. All right, I lied. 185 restaurants are being planned to close. So the restaurants will remain open throughout the bankruptcy process, the ones that they don't close. They do have 250. Oh, this is actually runneth over. I don't know why. Let's make this. There we go. There we go. They do have 250 restaurants, right? Right over here, you can see that. but they're going to be closing 185 of those. So I guess the remaining, what, like 70 restaurants around the world are going to remain open, and they're basically saying, hey, don't worry, don't worry, the actions are going to allow us an opportunity to reposition the company for long-term stability. Now, of course, you also want to keep in mind California Pizza Kitchen filed for bankruptcy in July. Chuck E. Cheese, which is actually the parent company to the California Pizza Kitchen, also filed for bankruptcy in June. And Sizzler filed for bankruptcy in September, so last month. So this is the part that is like really, really interesting, and we're going to talk about a little bit about the risks in a commercial real estate space. But one of the things that I think is important is that the U.S. visits to full-size service restaurants plunged 47% in April to June period, and upward, and then of course it's ticked upward since then, but still down 25% in August. Now, what do we know about August? Well, it's one of the hottest months, and you probably do want to go out, sit outside, dine. But the challenge with many of these places, Ruby Tuesday being one of them, is that the dining is indoors, right? And so, as I look at that stuff and understand that their dining is indoors, and understand that there are other restaurants out there as well that are going to have to move indoors because guess what? It's getting chilly. I mean, I have long sleeves on. Can you see this? So it's important to keep that in mind, that we will see way more of this stuff that is going to be rolling out. So if you're going to go into the retail investment, into the the restaurant and that kind of stuff, into that commercial space within real estate that is not necessarily potentially just residential, you definitely want to be very, very, very careful. And if this is a long term play, make sure you have long term money to make the play work. Fair? All right. So now we're going to be talking about mortgage rates. What are they? Where are we? What's going on? So mortgage rates are actually ticked on down yet again. A benchmark 30-year fixed mortgage rate is 3.05%. Average of 15-year is 2.56. 5-1 adjustable rate is at 3.09, still higher than a 30. And so here's the information right down here, because I think this is much easier to see, and you will actually see that here's the where the rates are, and then of course this is the APR over here, but these are the rates, and then here are the arms. Excuse me. And as you can see, 10-1 is 3.38, 7-1 is 3.13, and 5-1 is 3.09. And then jumbo, 30-year jumbo is 3.11, and 15-year jumbo is 2.58. Then you of course have the VA and FHA. VA 30-year fixed VA loan is 2.82 as of basically this morning, and 30-year fixed FHA is 2.9. Now, of course, the refinancing is becoming a bit more expensive, and they're all having all kinds of things that are happening. We do have news about JP Morgan Chase, so you definitely want to stay tuned in for that. Let's take a look at the refinance rates. So a 30-year fixed refinance is 3.04. 20-year, which most people don't get that, is 3.13. 15-year is 2.6, and 10-year is 2.63. So it actually costs you more. It costs you more to go shorter term. Are you noticing this trend? So 10-year is actually going to cost you slightly more than 15-year. And 20-year is way more expensive than 30 years. So which one are you going to get? Of course, probably you're going to go with the lowest one, but I would also suggest go with the lowest and the longest, because that gives you a better runway, as I always discuss on the show and elsewhere. Now, we do have some news that are coming in about mortgage rates setting another record low, sparking new strength in refinance market. So let's take a look. Mortgage rate moved even lower last week after setting multiple record lows. The average contract interest rate for 30-year fixed rate mortgage with conforming loan balance of up to $510,400, which is the conforming maximum, as we've learned recently. And hopefully you have watched that show. And if you haven't, you're going to find it on the YouTube. You're going to go into my YouTube channel, of course, The Money Matters with Nev K. And you're going to go into the real estate, and that's where you're going to find that information. It has slipped to 3.01 from 3.05, while points decreased to 0.37 from 0.52, with the loans with the 20% down. Refinance application volume, which is the most sensitive to weekly rate moves, rose 8% for the week and is 50% higher than a year ago, which makes perfect sense because the rates are way, way, way lower. So it makes sense why folks would absolutely do that. Purchase a home, applications to purchase a home fell 2% for the week, but were 21% higher than a year ago. Now, one thing that is interesting to note is that the purchase volume has been falling, and we are now down just over 4% from 4 weeks ago. So every week it falls a little bit, it falls a little bit, it falls a little bit, and that adds up. What we are doing is we're entering potentially seasonality component, right? That it's a little bit colder, people don't want to go out shopping, right? The uncertainty factor of, wait a minute, I don't know who's going to win in the election, so I'm not going to do anything right now. The those that wanted to buy already bought factor, right? Because that's also a possibility. So there are a few different things out there, and so things to be definitely paying attention to. I think refi is important, but at some point, folks run out of refi. Purchasing is important, but at some point we run out of those that want to purchase, especially as the prices tick on up. People get priced out of the market. We reach that sort of top of it, and then we start going the other direction. So there are signs that the demand is waning at the entry level portion of the market. As a result, the lower price tiers are seeing a slower growth, which is contributing to the rising trend in average loan balances. So, of course, average loan balances increased again to a record of $371,500 thanks to stronger activity on the higher end of the market. So, this is the part that is definitely important for all of us to understand and note, is that the fact that we are moving, the affordability obviously has been waning for forever, right? And is continuing to do so because demand really jumped through the roof, supply wasn't really there. Prices started to tick on up. So even if you could afford home A, for example, 6 months ago, today it might be out of your price range because it's been bid up and now you can't afford it, whereas before you could. So of course, those that couldn't afford the lower end are getting priced out, and they're actually stepping sideways and stepping away. However, the higher end of the market continues to play along as folks that do have money, that do qualify for, more money to buy more of a home, I guess, or more expensive home. I don't know if it's more of a home, but it's more expensive one. They are still in the play, and they are still participating in that particular component. Now, I did mention to you that I was going to talk about JP Chase Morgan. Or JP Morgan Chase. Sorry, I don't know why I changed that. JP Morgan Chase. So there have been quite a bit of news that we've actually shared here on channel that are talking about the fact of JP Morgan Chase taking advantage of people, lying to people, being deceitful, basically working against the customers, working against the government. When they get in trouble, they look for a bailout, a handout. They potentially get a slap on the wrist, pay a small fine, and then they move on, find another victim from which they're going to take money out of. A long time ago, I have learned about the fact that, when it comes to brains and money, those with brains will always figure out a way to get the money out of the other people onto them. And if this is the case, then JP Morgan Chase has a lot of brains. And in their new, I'm going to call it scheme, I I know that it could potentially be really, really good and that the news that they're sharing is really good and positive. I just don't trust these guys. So I'm going to put it out there to say I don't trust them. I don't trust their CEO. I don't trust that they're saying that they're doing this out of the goodness of their heart because I just don't think that JP Morgan Chase has a heart. So let's take on the news. You let me know what you think, how you feel about the whole thing. But I believe that this is just a scheme for JP Morgan Chase to make more money and to empowerish this population. As sad as it is, this is what I believe. I sincerely hope that I am wrong, and yet my gut feeling says this is going to end badly for the people. So, JP Morgan Chase makes $300 billion commitment to help close America's racial wealth gap. So, here it is, Mr. Diamond, Jamie Dimon, here we go. JP Morgan Chase is making $30 billion commitment to address U.S. wealth inequality, especially in traditionally underserved Black and Latino communities. A combination of loans, investments, and philanthropy over the 5-year period. This is the part that scares me. Not the philanthropy piece, but the loan and investment. This is the part that really, really scares me. Now, quote, systemic racism is a tragic part of America's history, said Jamie Dimon, CEO of JP Morgan Chase. In a statement, we can do more and do better. And so they decided they will. Now, earlier, prior to this announcement, a Bank of America and Citigroup each made $1 billion commitment to reduce inequality. I don't know what exactly that means because I didn't necessarily read about that piece, so I can't speak intelligently on it. If you have information, hey, let me know. I am all ears and eyes, as they say. The great bulk of JP Morgan's dollar commitment is tied to housing. This is the part that scares me all. This is the part that scares me. It just has 2005 written all over it, all over again, under a different premise. And that's the part that scares me. You can spin any story however you like, and this has spun directly on the hearts and hitting the points where it hurts the most and where it appears that it's going to help the most. And yet, I have serious doubts that this is going to happen. But let's read and let's hope Neb is wrong. It will provide $14 billion in loans and investments to spur the creation of 100,000 affordable rental units in underserved community. Rental units. Rental units. Okay? So they're going to pay potentially, I don't know, but I'm just thinking out loud here. They're potentially going to pay a developer to go out there into the underserved community, to quote the article and potentially what they said, to basically build an apartment that is going to be affordable housing, and that is how they're going to help. Now, of course, with laws changing, rules changing, and everything else, is it possible that the developer could set it up that and then spin it into something else? Absolutely. But whose name is going to be that we've helped the folks? Well, JP Morgan's. But I digress. They will also originate 40,000 home purchase loans for Black and Latino households, adding $8 billion worth of mortgage to its commitment. Now, JP Morgan Chase also said we're not making any loans to anybody. You have to have 820 credit score. Okay, it wasn't 820, but it might as well have been. And you're going to have to put at least 20 to preferably 25% down. And we're not doing any of that stuff. But now they're going to change everything. Now that the future actually looks more ominous than it did in March. So this is the part that is very scary to me. They're saying they're going to help another 20,000 Black and Latino customers lower their mortgage payments with a $4 billion in refinancing. The effort will include grants for down payments and closing costs, the bank said. Now, this grant, if it truly is grant for down payment and closing costs, that's quite lovely. Where my fear comes in is that they will basically prey on folks, prey on their emotions, and that they're basically going to go out there, make some loans that folks cannot afford to buy like they did in 2004, 5, 6, 7, before all it came down. And then they're going to foreclose on these poor souls. And then when things crash, they're going to get bailed out by you and I and the poor souls that also have paid hand over fist yet one more time. This is my biggest fear. And again, I hope I am wrong. The bank said that the $12 billion in additional mortgages is calculated based on the firm's 2019 mortgage volume for minority communities, of course. They will provide 15,000 loans with $2 billion to small businesses in Black and Latino neighborhoods and launch a new program to help coach entrepreneurs. I mean, if they launch a new program to coach them and maybe coach them for free, that would be amazing. But I don't know if they're going to do that. Maybe you have to borrow a lot of money to get coaching. I don't know how things are going to work. Again, I hope it all works out, but they never do things out of the goodness of their heart. There's always some sort of twisted math at the end of the whole thing, and that's the part that scares me. This is just a great PR for them because they're trying to get out of all of the bad news that have basically been hitting. They're true based off of what we can tell from the reports and stuff, right? From FinCEN and that kind of stuff. But now I think they're just looking for something, and I think that they sat in the boardroom somewhere and said, crud. We've been discovered again. We're paying all these fines. There's news everywhere. Our stock has been crashing. We have got to go out there and come out like we're doing something good for the people. Yeah. We're doing something good for the people. All right. How are we going to do it? Well, there's a lot of talk about unaffordable housing and inequality. Maybe we can step in and do something with that. And then they got their financial engineers to come up with something wonky that sounds really good on paper and the news article. And then on the back end is going to do who the hey knows what. And we're not going to discover it until years from now. And like I said, I hope I'm wrong, but we're recording this. It is October, what is today? October 8th, 2020. Let's see that by 2025, or later, because sometimes it takes a while to get information out there if we see something wonky come out of this. And let's see if I was right yet one more time. And this is one of those that I truly, sincerely hope. This is the one that I actually don't want to win. I want to lose on this one. JP Morgan also said it would give $1 million people in underserved areas access to low-cost bank accounts, in part by opening branches in low to moderate income communities. Now, one thing to note, when they do this stuff, they actually, again, don't do it for the access. They do it for extraction of wealth. Let me know what you think, how you feel about the whole thing. Maybe I am too cynical, and if I am, hey, let me know. I am just looking at historically what in the world they have done, how they have treated people, how they have behaved, and I am sorry, I just don't see evidence that says that they have learned from their mistakes and changed their hearts and minds. But let me know if I'm wrong, and let me know how you feel and think about the whole thing. All right, time to change tunes. Multifamily. Oh, this is my favorite piece right over here because we're going to be learning. We're going to be learning about some cool things. Now, multifamily, as you know, has to, in order to qualify for multifamily, it has to be 5 units and up. And typically, when folks are really talking about multifamily, they will talk 25, 50 units and up. But there are plenty of units that are between, 5 and 10, 5 and 20, 25 and so on. So there's a lot of units out there, and there's a lot of very cool reasons why you might want to consider getting into multifamily as opposed to residential. There are benefits to one versus the other. Some make sense for some stuff, other make sense for other stuff. like 1 to 4 units. It's easier. It's easier in some regards because you can claim it as a personal residence, but of course you have to actually live there. So don't lie. All right, don't lie. Um, you can get the 30-year mortgage. You can qualify for FHA or VA and that kind of stuff. So you get lower rates and that kind of stuff. On the other hand, when you go 5 units and up, you actually qualify for, it's still housing, but you're going to qualify for commercial loan. Now your income and becomes irrelevant. Qualification process is way easier because you're not qualifying, the property is qualifying. So as long as there is positive cash flow and it's actually doing what it's doing, you can get lending done way, way, way quicker. Now, the downside to it is that maybe the rates are going to be a bit higher. They will typically, look for 20 to 25% down, sometimes as much as 30 to 35%. So you want to be aware of that stuff. Oftentimes, they will do like 15 or 20-year mortgages as opposed to the traditional 30 that we're used to with residential. However, there are lenders out there that would do 30, even 40-year mortgages on commercial deals, but a lot of it depends on the size. So the larger the multifamily is, right, the more expensive it is, the more favorable terms you are going to get. But of course, you also have to have way more cash in order to get into those deals, right? Because remember, if you're buying, say, $1 million property, you need 200,000 plus closing costs, right? But if you're buying $100 million property, well, you will need 100 times more than $200,000, which makes it what? 20 million, right? So that's a substantial difference. But on a million, you might not be able to get a 40-year, mortgage. But on 100, you probably will have a very, very good chance to do it. And do keep in mind that vast majority of folks that do go into the 100 million kind of deals are typically syndications. Typically, not always, but I would probably venture to say 99% of the time. Now, syndication, if you don't know what it is, it's basically a partnership. It's sort of like a group of us get together, we pool our money. There's one person that is sort of the syndicator or the sort of the general manager of the whole thing. That is the operator that is going to go and put the deal together and deal with it and operate and do all of this stuff, deal with the refinance, and then rest of us are truly 100% in a passive role, meaning you literally do absolutely nothing. You just collect a check every month, every quarter, every 6 months, every year, depending on the structure of the deal. And then, of course, when the operator sells or refinances and that kind of stuff, then you end up getting your money back. The downside of being part of the syndication is that it can be highly illiquid, meaning when you commit to it, you're committing typically 3 years on the low end, to 10 years on the high end, and somewhere in between. Vast majority of them will fall between 5 and 7 years. So 5 to 7 years, you can't touch this money. Like, you might as well forget that it exists. But the nice part is when it's refinanced, when it's sold, whatever the deal is, and you'll know that before you get in, you will get your money plus whatever interest is due to you, and you will also be receiving income from that money. So it's not like you lose the money, you throw it away, but just plan that you won't have access to it. Vast majority of the syndication deals, they range in the deal. There are some that you can get in as low as 25,000. Typically, there's not a whole lot happening below that, but it happens. Vast majority of them will run at about $50,000 per person, or like per share, or however you want to call it. And then there are some that are really good high-end syndicators. They won't accept anything below 100,000, and there are some that I have heard of. It's $200,000. That eliminates vast majority of individuals, and for the most folks, you actually have to be an accredited investor, just because the deals are not as risky. It's just that liquidity, right? Like you can't give me every penny that you have and then call me up 3 months later and saying I need my money back now. Like, it doesn't work that way. And so for that reason, they're saying accredited investors, although in certain deals to a certain degrees, sophisticated investors can participate as well. And if you're curious as to the difference between sophisticated and accredited investor, I highly suggest you sit by your favorite search engine, type it in, and read the difference and the requirements. All right, I think we talked a lot. Let's take a look at this article and then we're going to learn from there. So, multifamily, an assailable asset class, develops some cracks. Yes, 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 yes. So, I actually do like this photo quite a bit. An influx lately of multifamily investment opportunities presented by sponsors as value add. Okay, so sponsors are typically going to be folks that are selling, that have deals, that have found deals, sort of like a realtors, right? But excuse me, not always. Sometimes a sponsor is part of this syndication deal stuff that you also need to remember, and sometimes so sponsor is basically the folks that are just trying to get you into the deal. Okay. However, upon a closer look at the underwriting, these deals do not actually fit the typical value add investment profile. So, these opportunities end up being cap rate compression plays under the guise of value add and are priced to perfection in today's market. Most of the return on investment is generated by rent inflation, buoyed or buoyed or whatever. This word right here, floated in the early years of the investment. I don't know what it means. I can't say it. Early years in the investment by positive debt service arbitrage due to interest only terms. Okay, let's break this down a little bit so that we can learn. So, and I've seen this actually myself a lot, and in my courses, when I do teach this stuff, I really do break it down and I tell folks you gotta be super, 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 super careful about this stuff. So here's what basically the deal comes in. I am ready to sell a deal, right? And in my wanting to sell a deal, maybe I can draw. Hold on. You know how much I like this stuff. You know how much I like this stuff. All right, let's go with red. Red is the color of bad deals. All right, so here's a property, right? And here's the property, right? And so I want to sell it, right? And I basically structured a deal in such a way that when presented to you, it shows the nice cap rate of, say, like, let's say 9%, which is not necessarily a bad cap rate at all, especially in multifamily. It's actually really, really good. Depending on where you are, the type of deal, the location, the whole 9 yards. I mean, you can look at cap rates being as low as 4 to 5%. Then that's typically like type A deals. Then you can go up to, probably 6 to 7, 8%, and maybe like, B, and then, C and D, you can see way higher, but, some of those are way labor intensive and some of those are probably really challenging, especially if you're not highly experienced and don't have a very, very strong team to manage the stuff. So, anyways, let's say it's a cap 9 and stuff, and I calculate it in such a way, but it's so hidden that unless you do your own evaluation, which you should all the time, don't think the sponsor, deals and stuff, and it's going to come in a beautiful brochure, right? This is a horrible drawing, but it's going to have beautiful photos, and it's going to have like some key bullet points. It's not going to have 5 print, and it's going to have these like, amazing charts showing you how you're going to go to the moon, and it might have very pretty ladies that are attached to it, right? And hey, don't ask me why, but it's absolutely the truth. Probably because vast majority, as unfortunate as this is, in this industry, tend to be men and tend to be baby boomer kind of personnel, right? Much older generation, because they're the ones who have money, and traditionally they all grew up saying that men are the ones that work, whatever. Anyways, agree with it, don't agree with it. This is not the show for that stuff. I'm just telling you what it is, and so they're trying to find these like really pretty, 20 somethings models that will be in this stuff because, well, let's just face it, man can be very shallow. Let's just call it what it is, y'all. Let's just call it what it is, right? And so then I basically, say, well, you're going to pay, this much money over here, right? But it's only down payment, and because it's interest only, right? Even if it is at, say, 7%, but it's interest only, meaning that if you do the calculation, if you ever go out there and get the mortgage calculator, it will actually break it down that says, interest, and it will say also principal. Well, these deals are typically structured as interest only, meaning that this piece is not paid off. So if you borrow, say $1 million, right, you will be making monthly payments right over here, but this amount is not going to go down. You are only paying the interest. And these, the interest only, are typical deals in some of these structures, especially for larger multifamily units, especially when in a value add. Because here's what happens in the value add. Okay, the value add, you basically go in, right? Hold on. You go in and you find this, property that is, here. And, there's some challenges and issues. And maybe you identify and say, okay, it needs new windows and new doors. I need to fix a roof. Maybe, I need to add the new, driveway and, some sort of green space that is in it. And maybe on the inside, I need to, improve the bathroom and the kitchen and that kind of stuff. That's a value add, because you go out there and you find a deal. Sorry. You find a deal that is value add. This is what value add is. But what they're saying is, once you actually look at the stuff, oh, go away. All right. Anyways, once you actually look at the stuff and how the deal is structured, it's not necessarily a value add. It's actually just a play on the rents, and basically saying, well, it's interest only, and if you put 35% down, right, like, and it makes it work, and then they say, well, over the next 3 to 5 years, the rent is going to increase 3%, 5%. I've actually seen some of these deals where they were like, the rent is going to increase what was it, like 7 or 10%, something like that. I'm like, what world do you live in? Because that's not the world that I live in. Anyways, here's the rub. If a value add opportunity requires market annual rent growth of 3% over annual expense growth of 2 to 3% over 5 years to hold the returns to work, it's not really a value add deal. True value add plays have renovations or management or leasing risks, so the increase in value from those activities should be enough to achieve returns in order to justify the risk on the shorter term hold. And so that's basically what is happening. There is a trap, and you might be involved in this trap. And the reason I wanted to share it with you is because some of you might be looking in syndication deals that are posed as a value add, but it's not a true value add. True value add, as mentioned, is that you go out there and fix something within a property, whether it's the property itself, whether it's a poor management, right? And so you got to bring new management and improve the operations by cutting costs, by getting the new type of tenant, for example, by restructuring the deal or whatever it is. And then once you do that, then you can actually raise the rents. And then once you raise the rents, that's where actually the value of the deal goes up. And then you can go and refinance or sell, and that's where the play is in how you make money and, of course, pay off your investors. If there's nothing to do, meaning no improvements that are going to raise the value, right? If there is no management stuff, if there is no raising of the profile of the renter, for example, of changing how we do this stuff, because you can't change location, right? So what are some other pieces that you can change, that you can maybe minimize on the operation expenses and that kind of stuff? If you're just relying that the rents are going to keep on going up 3 to 5%, that is a wrong way to get into it, whether it's a multifamily or single family property. So that is incredibly important for you to know. and understand, and that is why I'm mentioning it here right now and today. All right, here we go. I promise, man, I'm yapping a lot today. Let's talk. Let's continue. Let's continue. All right, so where are the people going? Here are the smaller metro areas that are adding population. Smaller metro areas are gaining population at a faster rate than the large cities, and we also know that the largest cities and most popular cities once are now the biggest losers, and you will see the numbers in just a moment. The nation's pricey tech hubs have begun to lose some of the residents, with many people looking for smaller and more affordable areas. Largest gains in net arrivals have occurred in the following area, and the winner is Jacksonville, Florida, at positive 10.7%, almost 11% gain in net arrivals from April to August only. This is insane. Salt Lake City, almost 10% at 9.6. Sacramento, California, sitting at third spot at 7.6. Milwaukee at 4.5, and Kansas City, Missouri at 3.9%. This is absolutely amazing and stunning and fabulous. And of course, these are the ones that have the lowest unemployment. They have the highest average, national average. Lower unemployment than the national averages. They have greater affordability and so on. And that's where folks are going into. Now, of course, there are the areas where the steepest declines are. And I'm going to pause here for a moment and give you an opportunity to try to guess who the winner is. Hint, hint, we've talked about it. Hint, hint, at the beginning of the show, I promised to talk about it, and that's how we're going to end the show, with the news of what's happening in this particular city. And if you want to let me know in the chat and the comments, by all means, do it. 3, 2, 1. Okay, here we go. New York City, the biggest loser, at negative 23.4%. Followed very closely by San Francisco Bay Area at negative 21.1%. Seattle is down 10.6%. Boston down 9.9%. And Portland, Oregon, down 9.67%. So, here is where the biggest growths are. One last chance to take a look at this stuff. And the biggest losers. So, there you go. And speaking of the biggest losers, I do have information about New York City that I have promised at the beginning of the show, and we're going to do this right now. New York City is doing something absolutely, well, same old. No, not really. Sort of, kind of, maybe. They are looking to rezone certain areas of Manhattan this time around. Now, if you remember, about 2 weeks ago, maybe, something like that, recently we did talk about the Industry City and how they were going to rezone it, make more jobs, make affordable housing, blah, blah, blah. And it all got killed massively because people didn't want more jobs, because more jobs means more people come in. As more people come in, they make more money. As people make more money, they want to pay for higher housing, and as that happens, the housing prices go up. So they don't want jobs. That was the insane thing that I had learned through that article. But this article is slightly different. Here is what they're looking to do. They're going to rezone Soho and NoHo for affordable housing. Mayor Bill de Blasio has announced that the city will take on rezoning fight that will include building affordable housing in two of the city's wealthiest and historic neighborhoods in downtown Manhattan, Soho and NoHo. The proposal would bring about 3,200 apartments into the area, 800 of which would be below market rate. This is the 800 of the affordable ones, which comes to 25% of the whole thing. This is important for later part of the article, so keep that in mind. The official announcement from the city on Wednesday came after months of community feedback and workshops. We have an opportunity here to create affordable housing, to bring to an area that has been upper income, greater mix of New Yorkers, and create more balance. Progressive zoning changes will pave the way for the next 50 years of growth while making two iconic neighborhoods more accessible than ever. The median asking rent in Soho was a whopping $4,159 in August, but it is down from $5,223 a year ago. So it's $1,000 cheaper right now to live there, median, of course, than it was a year ago. And here is where they're located and where the plan is. So you can see this is the area, right? And this is the Houston Street right over here, right? This is Broadway. Let me see. Let me see, where are we? This should be Canal Street right over here, right? So you have an understanding of where it is. The blue stuff that you see is the commercial corridors. So this is where the commercial stuff is happening, right over here. The sort of like a pinkish or whatever color you would call that are the historic cores. So those you can't really touch, although you can probably renovate, but you got to leave the outside, right, to look the way that it looked. And then the parks, well, they don't really exist in these areas, but they're on the outskirts of the whole darn thing. And then the housing opportunity areas, you will see that there's this small part right over here in NoHo, right? By this is Astor Place right over here, so this is right over here. And then in Soho, you will see it. It's right here where Wall Street is. See, this is Wall Street. This is Canal Street, right? So right over here, and then right over here, this is Center Street. Howard Street is right here. Baxter Street. So this is, and then of course Canal down here. So this is the areas that they're talking about. Fresh off the defeat of the developer proposed intercity city rezoning in Brooklyn that we talked about and I just mentioned over here, de Blasio and supporters of the plan are headed for what may be another bitter rezoning battle. And of course, it talks a little bit about who's involved and what the politics are, and I don't think that that matters as much. Well, it matters, and if it matters to you, make sure you do read about it. And one of the things that is important for you to know, if it really matters to you, is that an early community session is scheduled for October 22nd. So it is coming up in a couple of weeks. We want affordable housing in Soho. One of the folks that is like, I don't know how I feel about this stuff, but we don't want skyscrapers. So basically saying, hey, we want to keep this stuff, but hey, can we keep the historic components here? Over a period of 30 years, lots of affordable housing has been created, not in creation of new buildings, but in the conversion of existing factory buildings over to rent stabilization buildings. However, it is important to note that anyone currently moving in to lofts and condos start at $2 million. This is an important piece to understand. And many people are very, very excited about this whole piece. I do have very positive, hopes for it. But do keep in mind, it's not, they will like rezone it. But remember, it's only 25% that are going to be affordable housing. Everything else is going to be everything else. And this affordable housing is not going to be open for an open bid on the market and that kind of stuff, because you can't do that because it's going to get bid up. So it's basically going to go to the city's lottery component of the whole thing. And what they basically do is you have to qualify for it based off of the income. And 9 times out of 10, it's very unaffordable, even if you qualify, because you will have to pay potentially anywhere between 40 to 50 to even 60% of your income towards mortgage or rent. And to me, that's not affordable. That's not sustainable. That is just a way to basically take advantage of the people. I don't know. Let me know how you feel about the whole thing. Let's continue reading, and then you please do let me know where you are and how you stand on the whole thing. Soho's affordable apartment would be built under the city's mandatory inclusionary housing program, in which 20 to 30% of units of new developments are set aside as affordable and distributed throughout the city's housing lottery. The program has long been criticized as yielding too few apartments with strict income requirements and high rents that wind up being out of reach for most New Yorkers. As I've explained, this is what ends up happening. And I've seen it, and I've found some of these things, and it's nearly impossible to qualify. You have to make ridiculously low amount of money to qualify for it, but it doesn't come free, y'all. So this lottery, it's not like lottery, like, woohoo, I want a house for free. It doesn't work that way. It's a lottery that you have to make basically almost no money. And then you qualify for this stuff, and then you have to pay. But the pay comparison to what you make, you can't make it. Does that make sense? So this is the part of the challenge and the problem. Rezoning would be extremely helpful and powerful symbolic first step toward making it easier for families to live in safe areas near good schools, nearby jobs, and transit. And whenever possible, I will make sure to follow the story here on One Deal Away on Money Matters. Sorry, One Deal Away is a sponsor, but Money Matters is the show. I sometimes fail to say that. So, anyways, that's where we are. It's the end of the line, so to speak. Welcome to the end of the show. Smash the like button, hit the subscribe, hit the bell so that you can see the show tomorrow as well. Until then, stay forever money blessed, and do remember, you are only one deal away.